What if I told you that right now, while you're watching this? Thousands of AI systems are actively buying, selling, and predicting markets across the globe. These advanced systems operate at speeds and with a level of complexity that no human trader could ever match, fundamentally reshaping the financial landscape. Sounds like something out of a futuristic movie, doesn't it? But this isn't science fiction. It's the reality of a typical Tuesday on Wall Street, where AI has become an indispensable part of daily operations. But here's the real, pressing question we need to address. Is generative AI truly making smarter, more informed financial decisions that benefit everyone, or is it merely creating louder, flashier noise that obscures true market signals and adds to volatility? Let's cut through all the hype and sensationalism surrounding AI and finance and examine the tangible impacts it's having right now.
For decades, investing was a meticulous, time-consuming process that meant poring over countless balance sheets, diligently listening to earnings calls, and trying to outthink the collective wisdom of the crowd. It was a slow, labor-intensive, and inherently human endeavor.
Now, we've entered the era of generative AI, and with its arrival, everything about how we approach finance is undergoing a profound and rapid transformation. Think of traditional financial analysis like trying to read a single, dense book with only a small flashlight. You can only illuminate one page, gaining one insight at a time, making the process incredibly slow and limited in scope.
Generative AI, on the other hand, it's like instantaneously scanning every single financial report, every news article, every earnings transcript, and every relevant social media post published in the last decade, all in under a single second. This immense data processing capability is truly revolutionary.
And then, based on this colossal amount of information it has just processed, it can immediately write a brand new, comprehensive research note, complete with insights and recommendations. That's not an exaggeration or a futuristic dream. This incredible capability is not only possible, but is actively happening in financial institutions around the world today.
Consider JP Morgan's sophisticated AI system, LOXM. Its primary job is to execute massive institutional trades, for example, buying or selling $100 million worth of Apple stock, without causing any noticeable movement or disruption in the market price.
Old pull algorithms would simply split such a large order evenly over a set period. But LOXM is designed to learn and adapt. It constantly watches how the market reacts, adjusts its trading strategy in real time, and even mimics subtle human trader behavior to remain virtually invisible in the market, ensuring optimal execution. The result of LOXM's advanced capabilities? Significantly better prices for trades, substantially lower operational costs, and ultimately, billions of dollars saved for JP Morgan and its clients. And it's not just major banks like JP Morgan benefiting. Bloomberg, a leading financial data and media company, now extensively uses generative AI to draft comprehensive market summaries, streamlining information delivery. Instead of waiting hours for a human analyst to meticulously write up the Federal Reserve's latest policy move, you now receive a clear, concise, and easily understandable breakdown written in plain English within mere seconds of the announcement, dramatically speeding up information dissemination. Even individual retail investors are seeing direct benefits. Platforms like E-Trade and Fidelity are leveraging AI to scan your personal portfolio and proactively suggest tax loss harvesting opportunities, a sophisticated financial strategy that used to cost thousands of dollars in advisor fees. But here's where the integration of AI into finance gets particularly tricky and introduces new risks. AI doesn't just find existing patterns in data, it sometimes invents them, creating connections that aren't truly there.
It possesses the ability to detect correlations so incredibly subtle that even the most seasoned quantitative analysts might miss them. However, sometimes those perceived patterns don't actually exist in reality. They are merely statistical ghosts or, in AI terminology, hallucinations.
And when an AI system acts decisively on one of these non-existent patterns, these statistical ghosts, that's precisely when investment portfolios can experience significant and unexpected losses, causing them to bleed value. So yes, AI is undeniably automating research, trading execution, and portfolio management at an unprecedented scale and speed, fundamentally changing how financial markets operate.
It's incredibly fast, highly adaptive to changing market conditions, and its powerful capabilities are increasingly being placed directly into your hands, making sophisticated tools accessible to more people.
But here's the critical caveat: speed without genuine understanding or transparency into how decisions are made. That combination is a dangerous recipe for potential financial disaster and systemic risk. Which brings us directly to finance's biggest and most perplexing AI dilemma: the infamous black box problem, where the internal workings of an AI remain opaque and unexplainable. What happens in a scenario where no one, not even the brilliant engineers who designed the system, can fully explain or understand why an AI made a particular, potentially impactful trade decision? And even worse, what are the consequences when malicious bad actors inevitably start exploiting that inherent blind spot and lack of transparency within these powerful AI systems for their own nefarious gains? In part 2 of this series, we will dive much deeper into the inherent dangers of this black box phenomenon and explore how AI is already being weaponized for various forms of financial fraud and manipulation. Stay with me as we continue to unravel the complex and often challenging implications of AI in the world of finance. Imagine this. You hand your life savings to a robot.
It makes a series of trades. Your portfolio drops 30%.
You ask why, and the robot replies, "I can't tell you, but trust me, it made sense at the time." That's the black box problem. And in finance, it's not theoretical, it's happening right now. Traditional algorithms were transparent. If volatility is greater than X, reduce exposure. Clear, auditable. But generative AI? It builds its own internal logic from petabytes of data. The decision-making process isn't coded, it's emergent, and often completely opaque. In 2023, a European hedge fund lost over $20 million in a single week.
Their AI had started trading based on a correlation between shipping container prices and semiconductor stocks, a link that existed only in the AI's training data, not in reality.
The system wasn't broken. It was confidently wrong. And criminals are watching closely. AI-powered fraud is exploding. Deepfake audio of a CEO announcing fake merger news happened to a UK energy firm in 2022, cost them $25 million.
AI-generated analyst reports promoting penny stocks on Reddit and Telegram happens daily.
Even synthetic identities, fake people built from AI-generated faces, social security numbers, and credit histories are being used to open accounts, take loans, and vanish.
The scariest part? These systems mimic legitimacy. They use professional language, realistic charts, even fake regulatory disclaimers. To an untrained eye, they look 100% real. And regulation? It's lagging far behind.
The SEC has issued guidance on AI, but no hard rules. No requirement to explain how an AI makes decisions. No mandatory stress tests for hallucination risk.
So we've got systems moving billions of dollars with zero transparency. But it's not all doom and gloom. Because while some AI operates in the shadows, others are being built in the light.
In part 3, we'll look at the real success stories: Robo-Advisors, smart beta strategies, and hybrid models that combine AI's speed with human oversight.
These tools aren't trying to replace you, they're designed to empower you. And chances are, you're already using one. You don't need a finance degree. You don't need $1 million account.
You just need a smartphone, and you're already using AI in your financial life.
But not all AI is created equal. Forget the flashy AI stock picker apps promising 500% returns. Those are often smoke and mirrors. The real wins? They're quiet, reliable, and built on decades of financial theory, just supercharged by technology. Take Robo-Advisors, Betterment, Wealthfront, SoFi Invest, even your 401's auto portfolio. These aren't generative AIs writing sonnets about Tesla. They're sophisticated, rule-based systems that do 3 things exceptionally well. First, automatic rebalancing. Markets move.
Your 60/40 portfolio becomes 70/30ths.
The Robo-Advisor quietly sells high, buys low, and brings you back to target. No emotion, no hesitation. Second, tax loss harvesting. If a stock drops, it automatically sells to lock in a loss, offsetting your capital gains taxes, then buys a similar asset to stay invested. This alone can boost after-tax returns by 1 to 2% per year for decades. Third, personalized risk profiling. Answer a few questions: time horizon, goals, stomach for volatility, and the AI builds a portfolio that evolves with you. Get closer to retirement? It shifts toward bonds. Start a new job? It might take on more risk. And it's not just for beginners. Vanguard's hybrid model, combining human advisors with AI-driven tools, has consistently outperformed 80% of actively managed funds over the past 5 years, while charging a fraction of the fees. Even ESG investing is getting smarter. AI now scans thousands of corporate sustainability reports using natural language processing. It flags vague claims like committed to sustainability versus concrete actions like reduce Scope 3 emissions by 22%. That's how you spot greenwashing before it costs you.
The key difference? These systems are transparent. You can see the rules. You can understand the logic. You can override them if needed.
They don't pretend to be oracles. They're tools designed to remove friction, reduce emotion, and enforce discipline. And that's the real promise of AI in finance. Not magic returns, not crystal balls, but consistency, accessibility, and clarity. So here's the bottom line. Generative AI in finance isn't a revolution. It's a spectrum.
On one end, opaque, overhyped systems making unexplainable bets. On the other, thoughtful, transparent tools that put you in control.
The future belongs to those who can tell the difference. If you found this breakdown helpful, hit subscribe. We cut through the noise on tech, money, and the systems shaping your financial future every week. No jargon, no fluff. Thanks for watching.